for small entities. So small entities. So we have the following objective to understand the meaning of small entities as defined by the Philippine Securities and Exchange Commission, to identify the components of financial statements of small entities, to identify the recognition and measurement of the assets of small entities and the liabilities and equity. So first, we have to define small entities as given by the Philippine Securities and Exchange Commission. A, with total assets between 3 million and 100 million, or total liabilities between 3 million and 100 million. So you can compare this with your SMEs. Now, that are not required to file financial statements under SEC SRC Rule 68, that are not in the process of filing financial statements for the purpose of issuing any class of instruments in a public market, that are not holders of secondary license issued by a regulatory agency such as bank, investment house, and other financial institutions. Entities with operations or investments based or conducted in a different country with different functional currency shall not apply the PFRS for small entities, but instead apply PFRS for SMEs. We have the exemptions from PFRS for small entities. The following are exempted from the mandatory adoption of PFRS for small entities and instead may apply full PFRS or PFRS for SMEs, whichever is appropriate. One, a small subsidiary of a parent under full PFRS or PFRS for SMEs. A small subsidiary of a foreign parent moving towards full IFRS or IFRS for SMEs. Three, part of a group either as a joint venture or associate reporting under full PFRS or IFRS for SMEs. A small branch office of a foreign company reporting under full IFRS or IFRS for SMEs. 5, a small entity with a short-term projection that shows it will breach the quantitative threshold and the breach is expected to be significant and continuing due to its long-term effect on the entity's asset or liability size. A small entity which has been preparing financial statements under full PFRS or PFRS for SMEs and has decided to liquidate. We have the components of financial statements of a small entity shall include all of the following: statement of financial position, statement of income, statement of changes in equity, statement of cash flows, and notes to financial statements. The statements of income and changes in equity can be combined if the only changes arise from profit or loss, payment of dividend, correction of prior period errors, and change in accounting policy. Other comprehensive income. A small entity does not recognize other comprehensive income. All items of income and expenses are recognized in profit or loss. Change in accounting policy. A small entity shall account for a change in accounting policy in the same manner as full PFRS, except that comparative information shall not be restated. Any cumulative effect shall be recognized as adjustment to the opening balance of retained earnings or other component of the equity of the current period. Comparative information shall not be restated. Change in accounting estimate. A change in accounting estimate is recognized prospectively by including the effect in profit or loss in the period that it affected. If the change in estimate gives rise to change in asset, liability, or equity, it is recognized by adjusting the related asset, liability, or equity in the period of change. Then, correction of prior period errors. A small entity shall correct material prior period errors in the same manner as full PFRS, except that comparative information shall not be restated. An adjustment is recognized against opening balance of retained earnings or other component of equity of the current period. Comparative information shall not be restated. The basic financial instruments under PFRS for small entities, the basic financial instruments are cash, bank deposits, trade receivables and payables, loans receivable and payable, notes receivable and payable, investments in non-convertible preference shares, and non-mutable ordinary shares. Initial measurement. Basic financial instruments of small entities are initially measured at transaction price, including transaction cost. If the arrangement constitutes a financing transaction, the basic financial instrument is measured at the present value of future payments discounted at the market rate of interest for similar financial instrument. Subsequent measurement, debt instruments are measured at amortized cost using the effective interest method. Investment in unquoted shares shall be carried at cost less impairment. However, investment in shares traded in an active market shall be measured at the lower of cost or fair value, with changes in fair value recognized in profit or loss. Impairment of financial instrument. If the financial asset is measured at amortized cost, the impairment loss is the excess of the carrying amount over the present value of cash flows. If the financial asset is measured at cost, the impairment loss is the excess of carrying amount over the best estimate of selling price. Inventories are initially measured as cost, which comprise cost of purchase, cost of conversion, and other directly attributable costs. The cost inventories is determined by using FIFO, weighted average, and specific identification. LIFO is not permitted. Subsequent measurement. Inventories are subsequently measured at the lower of cost or market value. The market value is determined as the probable selling price to willing buyers at reporting date. The lower of cost or market value is applied individually to each item of inventory or to group of similar assets. If the market value is lower than cost, the difference is accounted for as an impairment loss. Next is investment in associates. Now, for an investor shall account for all its investments in associate using one of the following. So any of the cost model or the equity model. So there is no more fair value model. Under the cost model, the investment in associate shall be measured at cost less accumulated impairment losses. All dividends received from the associate are recognized as dividend income, the income statement. Under the equity method, the investments in associates shall be initially measured at the transaction price, including transaction cost. The investments in associates are subsequently adjusted to reflect the investor share of the profit or loss of the associates. Under equity method, dividends received from the associates are accounted for as reduction of the carrying amount of the investment and not income. In other words, you are going to credit investment in associate and not dividend income. Now that is under the equity method. Next, investment property is initially measured at cost, and the cost comprises purchase price and any directly attributable expenditures such as legal and brokerage fees, property taxes, transfer taxes, and other transaction costs. We have the measurement after recognition. A small entity shall choose as its accounting policy either the cost model or fair value model and shall apply that policy to an investment property. Under the cost model, the investment property is carried at cost less accumulated depreciation and any accumulated impairment losses. Under the fair model, the investment property is carried at fair value at each reporting date, with changes in fair value recognized in profit or loss. If it's a reliable measure of fair value is no longer available without undue cost or effort for an item of investment property. The investment property is accounted for using the cost model. Carrying amount at the date of change becomes the cost of the investment property. So the carrying amount or the book value. Next is property, plant, and equipment. For small entity shall measure property, plant, and equipment initially at cost, which comprises the purchase price and any directly attributable cost necessary in bringing the asset to the location and condition for the intended use. Subsequent measurement. A small entity shall choose as its accounting policy either the cost or the fair value model and shall apply the policy to an entire class of property, plant, and equipment. Under the cost model, a small entity shall measure the property, plant, and equipment at cost less accumulated depreciation and any accumulated impairment losses. Under the fair value model, a small entity shall measure property, plant, and equipment at fair value at each reporting date with any changes in fair value recognized in profit or loss. If the fair value is no longer available without undue cost or effort, the property, plant, and equipment shall be accounted for using the cost model. The carrying amount of the property, plant, and equipment on that day becomes the initial cost. Next is monetary government grant. A monetary grant that does not impose specified future performance condition is recognized as income when the grant proceeds are receivable. A monetary grant that imposes specified future performance condition is recognized in income only when the performance condition is met. monetary grant received before the revenue recognition criteria are met is recognized as liability. Non-monetary government grant. An entity has an accounting policy choice using either no recognition or recognition at fair value. Next is borrowing cost. Borrowing costs are interest and other costs that an entity incurs in connection with borrowing of funds, include interest expense calculated using the effective interest method. An entity shall recognize all borrowing costs as an expense in the period when incurred. A small entity shall not capitalize any borrowing costs related to a qualifying asset. Next is intangible asset other than goodwill. All intangible assets should be measured at cost. Subsequently, the intangible asset shall be measured using the cost model. Under the model, the intangible asset shall be measured at cost less accumulated amortization and any accumulated impairment losses, and shall be considered to have a finite life. And including goodwill, they are all amortized over the useful life. If the small entity is unable to make a reliable estimate of useful life of an intangible asset, the life shall be determined based on the best estimate of management, but not exceeding 10 years. Impairment of asset. If the recoverable amount of an asset is less than the carrying amount, an impairment loss is recognized by reducing the carrying amount to recoverable amount. Impairment loss is recognized immediately in profit or loss. Measurement of recoverable amount. The recoverable amount of an asset is the higher between fair value less cost of disposal and value in use. Fair value less cost of disposal is the amount obtainable from the sale of an asset in an arm's length transaction between knowledgeable willing parties less cost of disposal. In other words, fair value less cost of disposal is net selling price of an asset. Value in use is the present value of the future cash flows expected to be derived from an asset. Next is biological asset. A small entity shall recognize a biological asset or agricultural produce when and only when the entity controls the asset as a result of past event. It's probable that the future economic benefits associated with the asset will flow to the entity, and the fair value or cost of the asset can be measured reliably without undue cost or effort. Measurement of biological asset has the option to measure biological asset applying either the cost model or the current price model. Under the cost model, the biological asset is measured at cost less any accumulated depreciation and any accumulated impairment losses. Under the current market price model, the biological asset is measured on initial recognition and at each reporting date at current market price. The current market price is the probable selling price to willing buyers as of reporting date. Any changes in current market price shall be recognized in profit or loss. Next is measurement of agricultural produce. So, harvested from an entity's biological asset shall be measured at current market price at the point of harvest. Such measurement is the cost at that date when the harvested agricultural produce is accounted for as inventory. Next, we have provision and contingent liability. A small entity shall recognize the provision only when the entity has an obligation at the reporting date as a result of a past event. It's probable that the entity will be required to transfer economic benefit and settlement, and the amount of the obligation can be estimated reliably. Measurement of provision. Provision is both probable and measurable and shall be measured at the best estimate of the amount required to settle the obligation at the reporting date. Next is contingent liability, which is either a possible or present obligation that is not recognized because it is not probable that the entity will be required to transfer economic benefit, or the amount of the obligation cannot be estimated reliably. A contingent liability is either probable or measurable, but not both. So it's only either. Contingent liability is not recognized, but only disclosed when either probable or measurable, but not both. There is no need for disclosure if the contingent liability is remote. Next, leases. Small entities shall apply the operating lease model. So no more finance lease. There is no finance lease for small entities. All rental receipts shall be recognized as rent income, and all rental payments shall be recognized as rent expense. In other words, a small entity shall account for all leases as operating lease. Next, income tax. A small entity shall make an accounting policy choice using either a taxes payable method. The entity shall recognize a current tax liability for the tax payable on taxable income for the current and past periods. In other words, if the taxes payable method is followed, the small entity is not required to recognize deferred tax asset or liability. Deferred income taxes method, the small entity shall recognize a deferred tax liability for future taxable amount and a deferred tax asset for future deductible amount in addition to current liability. Measurement of deferred tax asset and liability shall be measured using the tax rates and laws that have been enacted or substantively enacted at the reporting date. Deferred tax asset and liability shall not be discounted. The carrying amount of deferred tax asset shall be reviewed at every year end. The carrying amount of deferred tax asset shall be reduced to the extent that it's no longer probable that future taxable income will be sufficient. Deferred tax asset is presented as non-current asset, and the deferred tax liability is presented as non-current liability. Next is employee benefits. Post-employment benefits or employee benefits other than termination benefits that are payable after completion of employment. An example is a retirement benefit such as pensions. Measurement of post-employment benefit. The accrual method is used in calculating the benefit obligation in accordance with the minimum requirement benefit under RA 7641 of the Philippine Retirement Pay Law. However, any company policy is followed if superior or higher than Republic Act 7641. The accrual approach is applied by calculating the expected liability as of reporting date using the current salary of the employees and the years of service. No consideration is made for changes in future salary and service period. Moreover, there is no recognition of actuarial gains and losses. In other words, only the defined contribution plan is followed by the small entity. Next, equity. As the residual interest in the assets of an entity after deducting all of its liabilities and shall be measured. Now, the equity instruments at the amount of cash received. If the payment is deferred and the time value of money is material, the initial measurement shall be on present value basis. If the equity instruments are exchanged for resources other than cash, the equity instrument shall be recognized at the fair value of the resources. An entity shall account for the transaction cost as deduction from equity and net of any related income tax benefit. An entity shall reduce equity for the amount of distributions or dividends to owners, net of any related tax benefit. Share-based payments. A small entity distinguishes between cash settled and equity settled arrangement. Measurement, the equity settled share-based payment transaction. A small entity shall measure the goods or services received and the corresponding increase in equity with reference to the net asset value of the equity instrument granted. Net asset value is derived by dividing the total assets less liabilities by the number of shares outstanding at measurement date. Net asset value is equivalent to the book value per share. For transactions with employees, the net asset value of the equity instrument shall be measured at grant date. Measurement for cash settled share-based payment transaction. A small entity shall measure the goods or services acquired and the liability incurred at the fair value of the liability until the liability is settled. The entity shall remeasure the fair value of the liability at each reporting date with any changes in fair value recognized in profit or loss for the period. Next is revenue. The amount, the accounting revenue shall be applied to the following: sale of goods, rendering of services, construction contract, deposits, or receivables yielding interest, dividends from investment in shares not accounted for using the equity method. The recognition criteria include the probability that the economic benefit associated with the transaction will flow to the entity and the revenue and cost can be measured reliably. A small entity shall measure the fair value of the consideration received or receivable. Now that's the revenue. The fair value of the consideration received or receivable is after deducting the amount of any trade discount from payment, settlement discount, and volume rebate. The fair value also takes into account the time value of money. A small entity shall apply the accrual basis of recording revenue and expense. Transition to PFRS for small entities. Recognize all assets and liabilities whose recognition is recognized by PFRS for small entities. Not recognize assets and liabilities if PFRS for small entities does not permit such. Reclassify items that is recognized under the previous accounting framework as one type of asset, liability or component of equity, but are a different type of asset, liability or component of equity under the PFRS, and apply PFRS for small entities in measuring recognized assets and liabilities. And the date of transition to PFRS for small entities is the beginning of the earliest period for which full comparative information is presented in accordance with PFRS for small entities. Now we are going to just read reconciliations. We are going to answer the multiple choice questions. I will share screen the answers to 30-1 up to 30-4. It's already time. So 30-1, you only have 5 questions. 30-2, another 5. 30-3, you actually have 10. And 30-4 is another 10. Okay, so that's all for today. See you on Wednesday.
Ma'am,
Yes?
ang sa problem,